let's go over the housing data, because we have to look at the good, we have to look at the bad, everything in between to do a proper analysis. And you get the bullish argument all the time with the mainstream media, although that's slightly changing. Chris and I talked about this yesterday, but there is another another crack in the dam that we have to pay attention to. And that's the housing market, not really seeing prices collapse, but you're seeing demand go down. And what's really odd is we have seen mortgage rates, as you would expect, go down significantly with the 10-year treasury yield, which you would assume would drive demand even higher. We're seeing the exact opposite. So let's go over to this article, another article from CNBC, and try to go over what's happening. Now, it's just over the last couple weeks. So the very short term, it doesn't mean that this is a trend that's going to continue throughout the rest of the year, but it's something that we have to be cognizant of right here. And actually, I'm curious, let's look at a chart of the 30-year mortgage rate, because I haven't looked at that in a while. And obviously that pertains to what we're going to talk about. So this is the 30-year, and look at this. From February, the 1st of February, we were right around 6.8 and 6.81, and currently we are down to 6.59. So that should encourage demand. Let's look at what's actually happening, though. When we go to CNBC, here's the title: Mortgage rates drop to lowest since mid-December. Not that long ago. But demand still falls short. Key talking points: average contract interest rate for 30-year fixed rate with conforming loan balances decreased to 6.88% from 6.93. So we saw a little bit more of an increase on NerdWallet. They're probably combining all 30-year fixed, where here they're focusing on a specific portion. Applications to refi a home loan, which had been surging through much of January, fell 4% for the week. Application for mortgage to purchase a home were flat for the week and 3% higher than the same week 1 year ago. So really where we're seeing the decline is on these refis, which that makes a lot of sense, because if you are hell-bent on buying a house for whatever reason, you're probably going to still move forward with that. You probably weren't going to buy a house if you lost your job, or you probably weren't going to buy a house in the first place if you were kind of leery about whether or not you would lose your income in 2025. But it's a whole different equation when you're looking at a cash out refi or a refi in general, because you've got fees. It's just, you already have the house. It seems like that would be the first shoe to drop. So the details here: mortgage rates dropped. Okay, we got that. The total mortgage application volume fell 1.2% from the previous week. Now, wait a minute here. I thought that it said that applications for a mortgage to purchase a home were flat for the week and 3% higher than the same week 1 year ago. Total mortgage applications fell 1.2%. What am I missing? The only thing, total mortgage applicant, maybe they're including the refis in there. I'm not sure where the discrepancy is, but the bottom line is it's overall, it's going the opposite direction of what you would think if you just looked at the interest rates themselves. Another thing that's really, I think, even more interesting, now that I'm thinking this through out loud, is why are the rates not going down at the same level as the 10-year treasury? So let's think this one through. Since the beginning of February, based on NerdWallet here, we've gone from 6.88 down to 6.59. So call it, 30 basis points, 28 basis points. But now let's look at a chart of the 10-year treasury just in February. And drum roll, please. We can look at the start of February. Okay. So I thought they're actually down more than that since the beginning of February. There's not too much of a delta there. So, okay, that's probably a nothing burger. Oh, that's right. It's CNBC. Okay, let's get back to this article. Treasury yields move lower on softer consumer spending data as consumers are feeling somewhat less upbeat about the economy and the job market. This pushed mortgage rates lower, with the 30-year fixed rate decreasing to 6.88%, the lowest rate since December. Applications, we talked about that. Overall refinance applications activity remained fairly weak We're talking about mortgage rates dropping. Long story short, this is a quote, bonds are in fashion at the moment. Okay, thanks for telling me something. Thank you for restating the obvious. The broadest and most common explanation has to do with expectations for downshift of global economic growth in response to domestic. Oh, they always have to blame the interest rates are coming down. Oh, well, obviously, growth and inflation, more so growth, expectations are coming down. It has to be because of the tariffs and blah, blah, blah. Look, I'm not a big fan of tariffs as far as an economic policy, but you can't blame them. They haven't even implemented the tariffs yet. You can't really blame them entirely for the 10-year treasury yield going from 4.8 down to 4.25. I mean, come on. It's almost getting to the point where that's like volatile food and energy. You guys, you watch my videos, you know how they have to include that on everything, excluding volatile food and energy whenever they're talking about inflation. And it's like that's the tariffs and the cost cutting efforts. That's the new kind of boogeyman for anything that happens bad in the economy. They have to insert that in there. I'm curious to go back to Nvidia to see what they're doing in aftermarket. Remember, it was about okay, so now it's up. Wow, it's up pretty good, 2.28%. So I guess the market is digesting this, and they're saying, okay, great, giving them the benefit of the doubt and share price increasing. But again, we're really going to, after hours, you can't tell too much. You're going to have to see how it plays out tomorrow. We'll go over that on tomorrow's video. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.